Good evening, everyone. My name is Iris Chu, and I'm a member of the UCL Centre for Ethics and Law. Tonight, we are bringing you an event on the transformations of corporate governance in Japan, and we have with us our anchor speaker, Professor Hiroyuki Watanabe, who is visiting UCL this year. So we are very pleased to have Hiroyuki present a paper that is work in progress and hopefully will be published very soon. We are also very pleased to have with us a very eminent panel of commentators who have read Hiroyuki's paper, and we expect our commentators to be giving Hiroyuki their feedback and comments, but also to be sharing some of their insights and perspectives on this topic broadly, on the role of investor stewardship in corporate governance, and especially in relation to Hiroyuki's vision that investor stewardship should facilitate a model of corporate sustainable growth, which I'm sure he will unpack in due course. So I'll be giving you a very brief introduction only to the speakers in the interest of time, and you can find all of the full bios of our speaker and our panelists on our event webpage. So Hiroyuki is visiting UCL at the moment and working on a variety of his interests in corporate law, securities law, as well as trust law. He's written prolifically in these areas, and we are very pleased that he's bringing this comparative perspective to us at UCL. In terms of our proceedings today, Hiroyuki will take the floor for about 20 to 25 minutes, followed by the panelists' comments. So in terms of the panel, panelists will each go for about 8 to 10 minutes each. And we'll only have questions and answers at the end, towards the end of the webinar. So with us tonight, in terms of our panel, first to be speaking will be Professor Paul Davies. Paul is very well known to corporate students, lawyers, researchers alike. He's a titan in English corporate law and currently an emeritus fellow at Jesus College at the University of Oxford. And he held the Allen and Overy Chair of Corporate Law at the University of Oxford for many years prior to his retirement. Paul is going to leave the webinar slightly earlier. And for those of you who might want to ask Paul any questions, please do feel free to send through the Q&A function any questions that you might have at any point in time during these proceedings. Following from Paul, our next panelist to speak will be Professor Irene Marie Esser, who is Professor of Corporate Law and Governance in the School of Law at the University of Glasgow. Irene Marie is also Dean of the Graduate School for the College of Social Sciences at Glasgow and is an extraordinary professor at Stellenbosch University in South Africa. Following from that, Dionysia Keteluzu will take the floor. She is Associate Professor, Reader in Corporate Law and Corporate Governance at King's College London. Dionysia has worked extensively on the topic of investor stewardship. And finally, we have with us an industry representative, and I'm really very glad that Claire Eltman can join us. So Claire is Director of Origination at Standard Life. She's an expert in pensions law and will have a lot of insights for us from the industry point of view in relation to investor activism and stewardship of assets. So this is our panel today, and like I say, we'll be taking questions only towards the end of the webinar after all the panelists have had their turn. So at any point in time, members of the audience, please feel free to send your questions through the Q&A function. I'll be moderating this during the Q&A session, and if we have too many questions, we might have to be selective, but we aim to be able to field all of your questions if possible, time permitting. And we plan to end this webinar at 7 p.m. UK time. So without further ado, shall I now invite Hiroyuki to take the floor? Hiroyuki,
Yeah,
over to you. Right.
yeah. Thank you, Iris. Hello, everyone. Thank you for joining us for this seminar. It's a great pleasure and honor to be presenting here today alongside such distinguished speakers. I would like to express my sincere gratitude to the speakers for their kind participation and to Professor Chu for her great efforts in making this event possible. The theme of my presentation is transformation of Japan's corporate governance and investor activism. The presentation will mainly address the following points. One, the reality of structural changes in Japan's capital market. Two, why investor activism has surged dramatically in Japan in recent years. Three, why a series of non-legally binding market soft laws have gained significant influence in Japan. And fourth, the characteristics of Japan's Stewardship Code. And five, towards sustainable corporate growth. And shareholders in Japanese companies used to be very passive when it came to exercising their rights as shareholders. For example, around 30 years ago, shareholders rarely exercised their voting rights against company proposals at shareholder meetings. This chart 1, shows the percentage of companies where the proportion of voting rights exercised with no instruction on the proposal is 1% or less. This, as of 1995, almost all the proposal was with no instruction of against. But in 2005, it sharply decreased to 45%. So from 1995 to 2005, Japan's capital markets underwent a dramatic transformation. Shareholding ratio of foreign and institutional investors increased dramatically, while cross-shareholding declined sharply. Over the following decade, the voting behavior of shareholders, particularly foreign investors, shifted toward a more active stance. Chart 2 shows the transition of shareholding ratio by major investment sector in Japanese listed company. From around 1995, the ratio of banks and etc. shareholding has been sharply declined, while foreign investors ratio has been sharply gained. And this chart shows trend in cross-shareholding. Blue line shows two-way cross-shareholding. It's it's so-called cross-shareholding. And red line is one-way policy shareholding. It's cross-shareholding in broad sense. This also shows that from around 1995 to 2002, the ratio has been decreased very sharply and still decreasing. So, and then situation has changed significantly since the establishment of Stewardship Code in 2014 and the Corporate Governance Code next year in 2015. Introduction of these codes has triggered positive exercise of rights and engagement by shareholders and is believed to have brought about major change in the behavior of shareholders of the listed companies. So these are market soft laws to facilitate investor activism. In 2014, Stewardship Code was established by Japan's Financial Service Agency, and on the same year, so-called Ito Review was published by MEDI, uh, Japan's ministry, the working group. And the next year was Corporate Governance Code was established. And in 2019, 2070, Stewardship Code was revised, and 2020. And regarding Corporate Governance Code, it was revised in 2018 and 2010, 20. And also, so-called PBR reforms by Tokyo Stock Exchange was conducted in 2023. So here, as a first is market soft law, I'd like to focus on Japan's Stewardship Code. Japan's Stewardship Code is a set of principles that enable institutional investors to fulfill their stewardship responsibilities. These responsibilities involve fostering sustainable corporate growth and enhancing medium to long-term investment returns for clients and beneficiaries through constructive dialogue. This dialogue is underpinned by a deep understanding of investing companies and their operating environments, as well as consideration of sustainability factors that are aligned with investment strategies. Stewardship Code was revised in 2017, which recommends the individual disclosure of institutional investors' voting outcomes. It is also considered to have substantially fueled the recent surge in investor activism in Japan. And 2025 revision, latest division, implemented in 2026 this year, by recommending collaborative engagement aimed to advance investor activism to a first stage. Also, by enhancing transparency regarding beneficial shareholders, it seeks to foster healthy engagement between investor and companies. So there have been many comments in Japan and internationally. There are some illusions about Japan's Stewardship Code, about specific position and evaluation. First, Japan's Stewardship Code was introduced as part of the Abe administration economic policy. It is accurate and important aspect. On the other hand, the following is a common misconception. Japan's Stewardship Code assumes that investors prioritize short-term profit seeking. True statement is that Japan's Stewardship Code explicitly envisages investors with a long-term orientation by the code preamble. Furthermore, the two statements cited below are rather misleading and require considerable clarification. In jurisdictions outside the UK and the US, shareholder structure are concentrated and institutional investors have limited influence. Therefore, UK-style code would be ineffective. However, Japan's shareholding structure has become highly institutionalized in recent years, as we saw. Also, based on the shareholding ratio of the largest of or major shareholders, Japan's shareholding structure is as dispersed as the UK in recent years. Moreover, the once typical practice of cross-shareholding has also declined sharply. This chart shows the ownership concentration by OECD countries as of the end of 2020. We can see that Japan is located in the lowest area together with United Kingdom and the United States, etc. And another illusion is that Japan's stewardship code aimed to force companies to release surplus funds to enhance financial efficiency. Regarding this statement, it's difficult to argue that Japan's stewardship code specifically aims to compel companies to release surplus funds to enhance financial efficiency, while promoting engagement between investors and companies is undoubtedly a key object of Japan's stewardship code. On the other hand, one of the Japan's market soft law in recent years, Ito review in 2014, is considered to raise advocated to raise the return on equity ROE to at least 8%. So this statement may apply to another market soft law. So this series of non-legally binding market soft laws gained considerable influence in Japan because activist investors, particularly hedge fund activists, have been extremely active in recent years, seeking substantial profit opportunities. From the structural imbalance between the globalization of shareholder composition and the inefficiencies in corporate finance. These market soft laws are believed to have served as the primary justification for investor activism, consequently playing a role in promoting for target companies to implement these soft laws. So, regarding investor activism by activist funds, here I call it as shareholder activism. Until around 2010, shareholder activism has seen little success in Japan. However, it surged dramatically from around 2015 onwards, and since around 2000, Japan has consistently ranked second globally in terms of the number of cases behind only the United States. The volume of shareholder activity in Japan appeared to exceed that of Europe as a whole in 2025 last year. Activist funds have invested in numerous Japanese listed companies, with their holding in Japanese equity exceeding 12 trillions by December 2025, equivalent to 1% of the total market capitalization of all listed companies. This chart shows the number of companies publicly subject to shareholder activist demands in major target countries. So, however, the recent high level of investor activism by hedge fund activists, etc., in Japan shouldn't be seen as a sign that the corporate governance structure has completely changed, but rather that it is undergoing dramatic change, I believe. While many Japanese companies have recently experienced significant improvements in these metrics, driven by a series of market soft laws and active involvement of active shareholders. Many others still have considerable room for improvement in these areas. On the other hand, this indicates that Japanese companies still possess immense untapped potential. Investor activity in Japan is intensifying further. Not only are activist funds becoming more active, but changes are also underway in areas that were previously criticized for being stuck in the old ways. For example, there is growing perception that asset managers now value activism as a force that drives reform and growth more sharply. This is reflected in the strengthening of the voting standards across asset management firms. For example, since June 2025, Nisse Asset Management, huge investment company, has opposed the appointment of representative at company with PBR below 1, who failed to present improvement measures. So, while investor activism has been rather rooting in Japan these days, there's an important point regarding Japan's stewardship code that is all too easily overlooked. A key characteristic of Japan's stewardship code is that it has explicitly stated the objective of promoting sustainable corporate growth since its inception. Some people regard this as merely a slogan to be disregarded because it's a result of political compromise or maneuver. However, in light of the significant increase in investor activism, achieving this objective will be the most critical challenge going forward, I believe. So, toward such sustainable corporate growth, priority tasks vary depending on the company's financial situation. To increase ROE or PBR are not considered the core issue in terms of promoting sustainable corporate growth. However, in terms of the company's reason for being, namely that its market value should exceed its liquidation value, achieving a PBR of at least 1x is a baseline that company management should strive to attain. Consequently, the priority task for promoting sustainable corporate growth basically depend on whether or not the company exceeds the PBR 1x line. So, for instance, share buybacks offer immediate effectiveness and hold certain merit as a means of improving a company's financial metrics. However, undertaking share buybacks also signals that there is no more promising use of funds beyond shareholder returns. So, focusing solely on such actions to improve ROE or PBR, etc., hinders the promotion of sustainable corporate growth, as sustainable growth requires investment in promising business activities. So, here I'd like to focus on the significance of engagement between investors and companies. Through repeated engagement centered on providing investors with persuasive explanation of the company's financial and capital policies, trust in management policies is fostered. Against this backdrop, when the company presents a future outlook that is both persuasive and supported by concrete evidence, and investors acknowledge its feasibility, new ventures can commence. I believe this structure fundamentally holds true even when the business in question encompasses social activities. While discussion often focus on how investor-led initiatives can promote sustainable social development and sustainable corporate growth, it's also important to recognize that company law in many jurisdictions, including UK, Japan, and even United USA, effectively grants directors and other officers broad discretion over corporate activities. Consequently, renewed attention should be given to companies' potential to undertake socially responsible business activities by engaging with investors, I believe. So I sincerely hope that Japanese companies will overcome intense market pressure of this global trend, implement structural reforms, and revive traditional sustainable corporate management in a new form as an extension of their engagement with investors. Thank you for your attention.
Thank you, Hiroyuki, for your presentation. And we all hear the plea, and I think that it raises a lot of interesting questions as to the nature of activism and stewardship, and whether investor involvement is always for short-term priorities and profit maximization, or whether they bring about long-term effects in terms of benefiting both themselves and their asset companies. Let me now invite Paul to share your comments as well as your slides, I believe.
Um, yes, am I both visible and audible?
Definitely audible. I can't see any slides at the moment.
No, the slides will come in later on if all goes well.
Right. Okay. Over to you, Paul.
Thank you. Okay, so I think Hiroyuki's paper has enormously added to our understanding of the changes in shareholding structure and corporate governance which have occurred in Japan this century. And they have been very significant changes. I guess until maybe the last decade of the last century, the conventional view of Japan was essentially a management-oriented structure of corporate governance. That is to say, the managers maximized corporate size rather than corporate profitability. Though there obviously was a minimum profitability constraint to keep the investors happy. But in the golden years of the Japanese economic miracle, that profitability constraint was relatively easy to meet whilst maximizing corporate size. And if you ask Japanese observers why the emphasis on managerial centric corporate governance, they would tend to point to the fact that senior managers in Japanese companies were and still are appointed from the internal management card rather than through an external management labor market. And it's obviously in the interest of the internal management card for the size of the company to be kept as high as possible, because that maximizes the number of management jobs and the prestige which is attached to them. If you asked Japanese observers why investors went along with this system, then generally you were pointed at the Japanese system of cross holdings in companies, and in particular at the role of what the Germans call the house bank, the bank at the center of Japanese groups, which saw their success as linked more strongly to their lending relationship with group companies rather than maximizing the return on their investments in those companies. Uh, uh, so uh, that was the view that I think most people took of Japan at the end of the last century. And four things seem to have happened to destabilize this arrangement. First, of course, the Japanese economic miracle ground to a halt, which revealed the tension between managerial and investor goals. Secondly, the large Japanese banks began to move away from a purely commercial banking model in the desire to imitate the success of the investment banks in the US. And for that purpose, they needed to redeploy the capital that was invested in Japanese companies into these investment banking activities. Uh, Third, the vacuum that was then created on the shareholder registers of Japanese companies was filled in part by foreign institutional investors, including foreign hedge funds, but only in part, as Hiroyuki says in his paper, Japanese institutions also moved into the gap and became what he calls stable shareholders. And I would find it very interesting to know a bit more about these stable shareholders and how far their conception of stability was favorable or unfavorable to the activities of activist hedge funds. And the fourth development, which is the one the paper concentrates on, was the decision ultimately by the Japanese government that encouraging engagement by investors with their investee companies might be a good way of revitalizing the Japanese economy. And so we got the Stewardship Code and its various reiterations, a corporate governance code, a certain amount of tinkering around with the takeover rules, and also a strengthening of the disclosure rules of the Tokyo Stock Exchange. And so the question which is really raised by all this is what impact, if any, did these changes have on the actual behavior of large Japanese companies, and through what channels did these changes, insofar as they occur, take place? And so I want just to spend the second part of my remarks just concentrating a bit on those possible channels. And here I'm going to take the risk of trying to share my screen. Does that show anything? Yeah. Yeah. Okay. So uh, I've identified, I think that Hiroyuki's paper and indeed the companion piece, which you find published in the Revue trimestrielle de droit financier, uh, uh, identifies three mechanisms by which this change might have occurred. The first is responses of a voluntary nature by companies to changes in mandatory disclosure rules. And there are two examples which are given. One is the reluctance of institutions once they were required at a granular level to disclose their voting decisions, the reluctance of those institutions to vote for the approval of the continuation of defensive measures against takeovers. And the second example is the disclosure requirements of the Tokyo Stock Exchange aim to encourage companies to achieve a price to book ratio of at least one. And that led companies to increase their distributions to shareholders, either by way of dividends or by way of share buybacks. And it would be interesting to know how that development should be evaluated in terms of a mechanism to improve the sustainable growth of companies. A second possible mechanism is hostile takeovers. Now, Hiroyuki is correct to say that it's not true to assert that hostile takeovers are not known in Japan and that they're never successful. And in his paper, he identifies 22 over the 13 years between 2007 and 2020. But given the size of the Japanese economy, that's a pretty small number of hostile takeovers. Only half of them, it is stated, were successful. And some of those were not even hostile takeovers for controlling blocks of shares. So it doesn't look to me as if the hostile takeover channel has been a significant one for the impact of these changes on the behavior of large Japanese companies. So that leaves us with activist hedge funds, and they, of course, constitute Hiroki's claim as to be the channel by which an impact has been had on large Japanese companies. And if I can get on to my next slide. Seems to be possible for me to make it move, but Hiroyuki has a slide in his deck. It's slide number 18, which shows there it is. It shows that there is a significant presence of activist shareholders in Japan. If you look at the number of demands on major target companies in Japan, it looks to be a fairly significant number. What I think would be absolutely fascinating for future research would be to know a bit more about those demands. What exactly was being demanded? Were the demands that fell within the sustainable category, if that's no matter how one defines that? And perhaps even more important, how did these demands actually fare? Did the sustainable demands, however defined, do as well or better or the same as more investor-oriented, maybe short-term demands? I think there's a big research project to be done there to analyze at a more granular level the nature and success of the activist hedge funds in Japan. And of course, that would feed into, of course, as we know, a very lively debate in other countries about activist hedge funds. The views on them vary radically from the European Commission at one end of the spectrum, which has, I think, or at least had at one stage, an almost completely negative view of hedge fund activism, to a lot of US scholars at the other end of the spectrum who would regard them as the only way of exerting pressure by shareholders in dispersed shareholding jurisdictions. So what would be really good if I can propose the next research project for Hiroyuki would be to know what experience the Japanese, what light the Japanese experience with activist hedge fund throws on the answers to those questions. Thank you very much.
Thank you, Paul. Can I now invite Ari Marie with her comments? Thank you, Ari.
Thank you so much, Iris. And can I just check you can hear me okay as well? Great, thank you so much. So thanks again from my side for inviting me to respond today and to be part of this panel. I really enjoyed reading the paper, and I hope that my comments would be of some help and provide some further insight. I would like to focus my comments on 5 themes based on the paper of Professor Watanabe. But before I do that, some comments from a UK perspective. So this article highlights how Japan's evolving stewardship framework is beginning to push beyond the UK model, raising important reflections for the UK's own regime. Japan demonstrates that when soft law stewardship is paired with strong shareholder rights, collaborative engagement, and greater transparency, especially around beneficial ownership, it can produce a more assertive and effective investor voice. In other words, with regards to the level of activism and stewardship activity, not necessarily its final economic impact than what is currently seen in the UK. The empirical evidence on outcomes is, however, mixed, and Japan's recent increasement in activism has not yet translated uniformly into superior performance improvements across all listed companies. In a recent article by Sheffens and Reddy, they also argue that the 2026 UK Stewardship Code effectively abandons efforts to promote shareholder engagement because it abandons the 2020 Code's requirement to report concrete engagement outcomes and returns to vague high-level principles that previously failed. They explain this reversal is driven by a political push to reduce regulatory burdens and boost UK market competitiveness, and conclude that the code is no longer a meaningful tool for strengthening shareholder activism. At the same time, Japan's emphasis on company-led sustainability rather than investor-driven ESG pressure suggests an alternative path that may avoid the UK's tendency towards process-heavy, standardized disclosures. So taken together, the Japanese experience prompts the UK to reconsider whether its stewardship code has become overly procedural, whether its reliance on voluntary institutional investor action is sufficient, and whether recalibration toward more substantive engagement, potentially supported by clearer expectations of transparency and collaboration, would actually strengthen long-term corporate governance outcomes. So be that as it may, as my first introductory remarks, let's then start by looking at the 5 themes that I identified. First, on ongoing transformation. One of the most compelling aspects of this paper is its insistence that Japan should not be regarded as having completed a transition to a shareholder-centric governance model. Instead, it is argued as a system undergoing dramatic change. The data that is assembled on ownership distribution, the collapse of traditional cross-shareholding networks, and increased foreign institutional ownership make clear that the structural foundations of Japanese corporate governance have shifted profoundly. Yet, the behavior of companies has not fully aligned with these new structures, producing what is called in the paper as persistent structural imbalance. So this framing is helpful as it pushes back against the overly binary narrative, which is often present in comparative corporate governance, that Japan has simply converged on an Anglo-American model. Instead, we are witnessing an evolving hybrid system where some firms have internalized the reform's logic and others remain anchored in older governance practices. Watanabe argues that Japan is in a state of structural change, with significant divergence between companies that have adapted and those lagging behind. This distinction is important, and it challenges much of the existing literature that assumes Japan has simply moved to a shareholder-centric model. Secondly, a crucial theme is the relationship between soft law reform and shareholder activism. The paper argues persuasively that the Stewardship Code, the Corporate Governance Code, and other reforms produce a regulatory landscape in which activist hedge funds effectively became the enforcement mechanism. The UK, on the other hand, has always had a background level of private routine engagement by long-term institutional investors. For example, discussions with management, voting pressures, signaling concerns, and so on. And therefore, focusing too heavily on hedge funds understates the importance and continuity of this quieter form of stewardship that predates the code. Thirdly, the third contribution in this paper is Watanabe's careful dismantling of several long-standing misconceptions about Japanese capital markets. Many scholars and commentators continue to describe Japan as a system dominated by cross-shareholdings, protected by stable shareholders, and insulated from hostile takeovers. But the evidence presented in the paper shows differently. The paper's empirical grounding is important, not only for domestic policy debate, but also for international scholarship. Much comparative governance work still relies on outdated portraits of Japan, and this paper provides a timely and accurate corrective. In responding, I would emphasize that corporate governance discourse is often path-dependent, where alt narratives persist even when the underlying data no longer justifies them. This paper helps to reset that thinking. Fourthly, the paper's discussion of sustainability is sophisticated and deserves special attention. Rather than repeating the usual observation that sustainability pressures come from investors, it highlights a different possibility, that companies themselves may be better positioned to identify and pursue socially valuable initiatives, provided investors trust the firm's financial foundation, of course. This argument has two strengths. Firstly, it recognizes that sustainability cannot be reduced to a governance checklist. And secondly, it acknowledges the wider managerial discretion inherent in corporate law, especially in Japan, in the UK through Section 172, and in the US under the business judgment rule. But it also raises a challenge. How do we distinguish genuine long-term sustainable strategies from managerial opportunism disguised as stakeholderism? I would have expected a clearer articulation of the fiduciary foundation of stewardship, focusing perhaps on the tension between the two tracks, in other words, corporate and financial, that make the legal dimension of stewardship a challenging process. The paper suggests that the key lies in continuous data-driven engagement and investor trust, grounded in financial discipline. For example, demonstrating financial governance, clear financial strategy, and disclosure. Thus, only after investors are convinced that management is financially competent will they be willing to trust and support company-led sustainability initiatives. This is promising, but still leaves open how such trust is built across firms of varying sophistication and capital market visibility. A future avenue for research might compare companies with different capabilities to engage meaningfully on sustainability and ask what institutional conditions allow company-led initiatives to thrive. And finally, on the 2025 revisions. Let me comment on some of the governance implications linked to those revisions. These reforms are significant because they push Japan further toward transparency and collective investor action. They also signal an evolution of the stewardship regime, identification of dialogue, and collaboration to reduce costs and increase impact. However, the push for transparency raises some questions. Does identifying beneficial shareholders give management better tools for engagement, or does it simply allow firms to anticipate and preempt activism? Also, are ultimate investors, especially retail, very interested? They really pay institutional investors to do that. The paper acknowledges some of these tensions, but could go even further in discussing how Japan can balance enhanced investor power with a commitment to long-term sustainable corporate value. So to conclude, Professor Watanabe provides an analytical account of Japan's governance transformation, one grounded in evidence, sensitive to policy nuance, and attentive to the interplay between law, markets, and corporate behavior. For me, the central insight is this. Japan has not become activist dominant intentionally, but because the structural and regulatory changes made such activism inevitable. The task ahead, as the paper suggests, is to ensure that this activism steers companies towards long-term sustainable value rather than a narrower financial focus. That challenge of balancing investor voice with corporate purpose will define the next phase of Japan's governance evolution. Thank you so much.
Thank you. Thank you, Ari Maria. So there is a lot in your comments that I would agree with, and I hope Hiroyuki also finds them to be very, very helpful. Without any further ado, let me pass to Dionysia.
Thank you, Iris. I hope that you can see my slides, correct? Perfect, right. So thank you so much for inviting me to comment Hiroyuki's paper and join this panel. As you can see from the title of the slides, I want to pose a deliberately stark question. Are we talking about enlightened shareholder stewardship, or is Japan's transformation more about financial discipline? And I think that Japan's governance transformation can plausibly be read in both ways. It may represent the emergence of more responsible, more long-term shareholder stewardship, but at the same time, it may also signal the consolidation of financial discipline through soft law benchmarks like return on equity or price to book ratio or capital efficiency, which is simply operationalized by activist investors. So what I will try to do in the next 8 to 10 minutes is three things. First, I will try to situate Hiroyuki's account within a broader theory of stewardship. Secondly, I will try to identify what the paper gets right about soft law and activist enforcement, but also where deeper tensions may remain. And thirdly, I will try to reflect on what the 2025 Japanese Code reveal about whether sustainable corporate growth can retain any substantive meaning under intensified shareholder activism. So let me begin with what Hiroyuki's paper shows. It is clear that Japan's Stewardship Code, the Japanese Corporate Governance Code, but also the recent reforms by the Tokyo Stock Exchange together form a very strong market soft law ecosystem. And these instruments reinforce one another, they reshape expectations, and they recalibrate what count as responsible governance. Of course, activist investors operationalize that ecosystem. So what Hiroyuki calls as regulator-driven activism captures an important insight. Soft law gets bite through private enforcement, through activist voting, through activist campaigns, through reputational pressure, and through escalation. So I completely agree with that account, but I would push it a bit further. And my starting point would be that we need to understand that when we talk about investor stewardship is not just firm-level engagement. It is power exercised across the investment chain. Also, in a similar vein, shareholder activism is not simply about firm-specific engagement. Shareholder activism today has evolved beyond proxy fights, beyond firm-level engagement, and it operates within broader debates about institutional authority, about governance norms, and about long-term value creation and sustainability. So from that perspective, soft law does not simply encourage activist behavior, but it structures the exercise of investor power, and also it legitimizes some of that power and perhaps prioritizes specific metrics and frameworks about what success looks like. So, in my view, what Hiroyuki calls as regulator-driven activism is more than enforcement. And it reflects that soft law, either in Stewardship Code or in corporate governance codes, becomes more, in a way, more justificatory. And it is becoming more as a justification for shareholder authority. So from that perspective, the key question for me is not whether stewardship is exercised or whether shareholder activism is exercised, but is more about toward what ends is this power being channeled? And that's my next point. In broader work that I'm doing over the past 10 years, I have conceptualized stewardship as operating across 4 relational layers. And you can see on the slides a very simple diagram, a very simple flow of funds, where you can see stewardship across the investment chain. So what I call as client stewardship concerns the relationship between asset managers and asset owners. So here, you may think of mandates, fee structures, performance benchmarks, reporting obligations, all these shape that stewardship relationship. There is also what I call end investor stewardship, and that's really important when stewardship is delegated, because in that case, asset managers and end investors, the ultimate beneficiaries like the pensioners or the insurance policy holders, are not directly linked. And then it's asset stewardship. And I think that this is the layer that Hiroyuki's paper focuses on. So this is about engagement with invested companies as productive entities. And of course, here we talk about dialogue, voting, escalation. But again, stewardship is not just about that. It's not just about the asset. It's also about the beneficiaries, the clients, but it's also about the broader system. And that's where the sustainability language gets in. And here we need to think about portfolio-wide and macro-level risks like climate transition or biodiversity loss, for instance. So I think that stewardship needs to be discussed across those 4 layers. And the discussion in Japan seems to be mainly focused on that portfolio asset level, at the level of the asset. Again, just to give you just to situate the Japanese discussion within a broader theory of stewardship. In my forthcoming book, I develop a multidimensional typology of stewardship across different varieties. So again, stewardship is not a single practice, but it varies across different levels, from the firm-specific level to the macro level, across different actors, service providers, ESG providers, asset managers, asset owners. There are different motivations, which I think somehow this is implied in the paper. So it's value-driven, but it can also be value extractive. And also it's individual, collaborative, so there are different means. And in this work, the concept of enlightened investor stewardship is introduced not just as a normative aspiration, but as a way to ground and understand how investor power operates across the investment chain. And this work is supported by empirical evidence and disclosures, a unique disclosure data set of UK Stewardship Code disclosures both from the 2012 code and the 2020 code, which I think provides some very interesting lessons for Japan. So first, the data showed that there is a substantial expansion in reporting volume, but despite this expansion, there is ambiguity about the stated purpose. So there is a lot of ambiguity about what stewardship is for, who stewardship serves. And there is a clear divergence between the way that asset managers and asset owners understand and practice stewardship. They prioritize different objectives, and of course they face different capacity constraints, which we need to recognize. And also, it's clear that the ESG rhetoric has expanded significantly in the UK, but the operationalization is uneven and inconsistent across large funds and smaller funds. And I think that's also quite important for Japan to consider. The next point I want to raise is that Japan's reform debate seems to be centered on the firm level, at the firm level governance, so on asset stewardship. But we shouldn't limit ourselves into examining shareholder activism and stewardship at that level, because activism does not remain confined to that layer. It also shapes how beneficiary interests are interpreted. It also integrates or sidelines systemic concerns. And also, if you only focus on asset stewardship, then you measure success primarily through financial metrics. And other layers of risk are disregarded, for instance, beneficiary welfare or systemic risk. So for me, when the Japanese code speaks of sustainable corporate growth, the key question is, what does this mean? So what does sustainable corporate growth mean? And also, the core question for me, after reading the paper, is that when activists in Japan invoke the stewardship language to press for buybacks, for instance, or restructuring or board turnover, are they advancing the code's normative commitment to sustainable growth, or are they leveraging the legitimacy that stewardship language now carries? And this echoes one of my papers back in 2022, where I found empirically that the language that is being used by activists does not really reflect what they actually do in practice. So I think that's an important question to consider and reflects the evolution of the UK code. So just to sum up, the paper ends with 3 key important revisions in the 2025 code, which I think they are really useful, but they simply improve the infrastructure. They do not resolve the normative tension. I mean, beneficial ownership transparency strengthens identification, collaborative engagement clarifies legal space, and streamlining is really important to reduce the reporting overload, but none of them clarifies what sustainable growth means for Japan. So the 3 questions that I'm going to invite Hiroyuki to think as he develops his topic is, what does sustainable growth really mean? Is it about firm level earnings? Is it about beneficiary returns? Is it about system resilience? So what does it mean? Then the next question is, does collaborative stewardship democratize governance, or does it entrench capital power within a small number of large asset managers? And the final question is, if we rely on activists to enforce soft law, then what does it count as success? In other words, is it simply about return on equity and high return on equity? Is it about stronger governance capability? Is it about long-term investment discipline? Or is it about systemic resilience? So I think that this is the most important question that Japan now confronts. Thank you very much.
Thank you, Dionisia, for your thoughts. I do agree that there can be a cleavage between basically expanding the paradigm of looking at shareholder power and rights and their participation in Japanese companies versus a very instrumental view of stewardship, which could be what we are witnessing at the moment in Japan. Right. Can I now turn to Claire to invite your comments, especially your perspectives from the industry that we're very much looking forward to hear. Over to you.
Thank you very much, and just truly an honour to be with you all this afternoon. I can talk from the position of a UK life insurer. I have very little experience of the Japanese market, and wouldn't really feel qualified to comment on a highly academic paper looking at how things work in Japan. But what I can offer up is a close look at how we work and why we take the decisions that we take at a corporate level, and would invite you then to take from that features that you would find interesting in relation to what's been written and what's been discussed. So if we can move on to the first slide. So what I'm proposing to cover: introduction to Standard Life, just who we are, what we do, an overview of what I'm going to be talking about. We are a company that has published our voting principles, so I'll talk you through those. We have also published a net zero transition plan, there's a very interesting feature recently published in the last few days, which is a UK sustainability charter for what we refer to as bulk purchase annuities, and I'll describe that. And then I'll come on finally to talk about the role of the regulator, the insurance regulator in the UK, which is the PRA. And I hope that putting that package together of information will at least allow you to think about our journey and then how that may impact on the paper. And if I may say, I think the speaker before me shed some very interesting or asked some very interesting questions, which at the end of the day is then very much about what is the aim and where are you trying to get to as much as anything else. So if we can go on to the next slide. So Standard Life, we had a rebrand today. So we had been a brand owned by a holding company called Phoenix. Now there's just one brand. It's just Standard Life. We look after 300 billion sterling for about 12 million customers. So 1 in 4 UK adults are customers of ours, and we help customers save for their retirement, and then we help turn their savings into income, and that's all we do. We have an in-house think tank as well, which contributes to the retirement debate. You may hear about that. And I speak really today on behalf of one of the aspects of the business, which is referred to as pensions risk transfer. So these are private defined benefit pension schemes. So this is where employers have made a promise to their employees that when they come to retire, they will have a guaranteed benefit. Those pension schemes are held by employers, and when funding is sufficient, those schemes think about whether to transfer away from the responsibility of the employer to an insurer. So they will hand over large scale assets, anywhere from single digit millions up to some of the largest schemes in the UK are kind of 70 or 80 billion, and all of the sizes in between that. So when I come on to talk about the most recent charter for bulk annuities, that's what I'm talking about. If we could go to the next slide. So an overview of what I would like to talk about today. What is driving our focus on stewardship? And for the purposes of today, I'm focusing on stewardship. Essentially, this is customer and client driven. I think realistically, if there was non-binding codes of governance that didn't help us in any way with client retention or in winning new business, my expectation would be, as much as we would point to it as a very welcome development, I don't think realistically we would be as serious about it as we are. So why is it that we as a business find this to be such an important feature of what we do? Really, that it's because we are we have obviously duties to our shareholders to deliver returns, and for that we need customers, and this is a great interest of customers, both institutional clients of ours and individual clients, individual customers. And therefore, what we do, we say we do on behalf of our customers. So from the first slide, as I referred to, we have 12 million customers, and 1 in 4 people in the UK are customers of ours. So therefore, it's a responsibility that we take very seriously. we have publicly available, as I've said, global voting principles. We've set out our net zero transition plan, and then we've said that we comply with the UK Stewardship Code. And also, this is the new development. In the last few days, it's been published. There is now a Sustainability Principles Charter for the bulk annuity process. And then finally, as I mentioned, we're subject to regulation by the PRA, and they've recently issued a supervisory statement asking banks and insurers in the UK to go further. But this is then from a risk management perspective in relation to climate risk. But obviously, stewardship does come into that, but it's through a different lens, if you see what I mean. But I felt that it was important to cover it, because I don't think you can, certainly from our perspective, ignore that regulatory oversight. So if we could turn to the next slide. So I'm just going to refer to various extracts from our global voting principles. So first of all, we believe that institutional investors do bear responsibility to vote at shareholder meetings and engage with companies. And the purpose of that is to drive better corporate behaviours, which should also then lead to stronger and more sustainable financial outcomes for our customers. We see ourselves as taking an approach of being critically supportive of the companies we invest in. We will use votes to support or challenge aspects of corporate governance and sustainability. And then to the earlier point made actually about where does power lie, we will vote against companies' management recommendations, and we would encourage full transparency. And interestingly, I'll come on to talk about this more, but in terms of our net zero policy, but we have said publicly that where our engagement does not lead to change after more than 3 years of dialogue, we intend to recommend the exclusion of assets that do not align with our climate and sustainability strategy. So we will then exclude those assets. We will divest from those assets. So if a company doesn't take account of what we're asking for. So just, you know, to pick up the comment made previously, it's a very interesting feature if you think actually what is the chain of decision making, because we are acting on behalf of our institutional or individual clients. We're saying that we will divest from those companies that don't comply with our requirements. Then we are effectively impacting the business of those companies, and if they then are, in the same way as we are, seeking to act on behalf of interested commercial entities, then they are by that obviously then impacted by what we're doing. And then because obviously we have the scale that we do, we have quite a large voice in these things. So if we can go on to the next slide. We see voting and engagement as connected. Obviously, engagement is effective to improve understanding of practices and inform decisions. We think that boards and management should aim to use engagement meetings as an opportunity to explain their business model, long-term strategy and operational practices. But we think it's very important for there to be a two-way dialogue. And we engage with companies and regulators on key strategic and ESG, that's what we refer to as environmental, social and governance. That's the kind of acronym that's used in pensions topics, both directly and alongside other investors, including through collaborative initiatives. So this is just an extract. Obviously, it's all available online. And I think there's one more slide just focusing on this an extract, and then here's the stick. And we're saying if despite several engagement efforts, and forgive the language which has been highlighted, obviously there's engagement and there's activism and so on, but this has not been written from the perspective of an academic legal perspective, so the language probably isn't as tight as you would use. But if despite several engagement efforts, companies do not make the improvements we expect, we will consider all forms of escalation. And then we go on to say we expect our asset management partners to be prepared to take similar action for engagements conducted on our behalf, because we invest ourselves and we invest through asset management partners. But obviously we're saying escalation includes collaboration, supporting votes against management, speaking at AGM, filing and co-filing resolutions, and but the big point here, recommending no additional investments, actually decreasing exposure and ultimately divesting of the holdings, which really is the most powerful technique that we have to enforce change. So I just can see that time is going by. So if we can go to the next slide. So as I referred, this is a public document. This is our net zero transition plan. So of that 300 billion sterling under administration, about 40 billion of that is held for the purposes of the shareholders, and about 260 billion is held for the purposes of policyholders. Here what we're saying is we held 5,650 engagement meetings with over 2,500 companies and 16 asset management partners, and these are the key topics that was covered: climate change, nature, human rights, UNGC controversies, and corporate governance, including board composition. So that's the kind of level of engagement and stewardship that we've operated. In terms of direct engagement, I mean, what we say is that our direct engagement, so this is where we ourselves are obviously engaging directly with the companies that we invest in. We've selected 25 companies which account for 40% of our financed emissions in material sectors in the corporate fixed income and listed in corporate fixed income and listed equity. And companies were prioritised on the basis of their current emissions sector and action to date on climate change. And then in respect of indirect engagement, so this is about 460 companies. This is then through our asset management partners, because as I mentioned, we manage our own assets, but we also work through asset management partners. This collectively accounts for a further 29% of our financed emissions from material sectors. So you can see that's the kind of way that we are engaging through stewardship, and as referenced on the earlier slide, if we don't see the changes that we expect, we obviously reserve the right to disinvest. If we could go to the next slide. So this then is a charter that has been put together on behalf of the key bulk annuity providers. So as I mentioned, about 1.4 trillion of sterling will move from private employers over to insurance providers, likely over the next 10 to 15 years. And the bulk purchase annuity providers, there's only about 10 of us, to be honest, in the UK. We've collected together because of obviously the significant scale. We've collected together and put together this charter, which, as I mentioned, was only published a few days ago, highlighting 4 areas: transparency, decision making, reporting and engagement, and collaboration. But back to earlier points that were made. Obviously, this is soft law, and is defining what's important. So key features, for example, of transparency, that insurers have a formal net zero commitment. When it comes to decision making, there's similar kind of what does good look like, and that's set out then in the charter. So I'm just very aware of time, and I don't want to dwell further, but it is quite an interesting document, I think, particularly if you think of the scale of assets that this potentially covers. And then just finally, I'll give you 2 minutes on the PRA. So the PRA, which is the insurance regulator, isn't satisfied with what banks and insurers are doing, and we have a 6-month window to complete a gap analysis and develop a credible and ambitious roadmap. Which will, I'm sure, for all of us, include stewardship and how we are approaching that. So hopefully that was interesting, a kind of whistle-stop tour of kind of what impacts us and why we're moving in the direction we're moving.
Thank you, Claire. And I think that was really, really interesting in terms of seeing how fiduciary-driven stewardship is, as well as
Yes.
compliance-driven, very important factors. So I hope, Hiroyuki, you have collected a lot of very useful comments, for your paper for further development. We do have a question, and we also only have 7 minutes left to the end of the seminar. So although I would have wanted to give you an opportunity to respond to panelists, I think maybe what I'll do is I will send you the first question that I received, and then if there are other questions to come, we'll take them as they come. If not, then we'll give you a final chance to respond to the panelists before we close the webinar. So question has come in from someone who's joined from New York. Welcome and thank you for being here. Antonio's asked the question, while the improved Stewardship Code has given the base for basically corporate governance action by shareholders, he thinks that the real change only took place with the 22-23 Tokyo Stock Exchange reforms, as well as the actions taken by government ETF ownership, pushing for improved ROE, as well as the Japanese pension fund, the GPIF stewardship. So I think the question focuses on the salience of financial discipline, especially the importance that Japanese investors themselves place on financial discipline. I'm not quite sure whether there is a precise direction the question is going, but perhaps what he's asking is whether this is, this is the key thing that is sought to be achieved, and it has been achieved. Hiroyuki, what do you think?
Yeah, thank you. I think in terms of improving companies' financial metrics, maybe so. Tokyo Stock Exchange's 2023 request initiative might be the main initiative. But regarding investor activism and sustainable corporate growth, there are many other aspects, I think. So if we focus on the improving ROE and PBR, Tokyo Stock Exchange's request might be the main driver. Although it states also sustainable corporate growth.
Right. Thank you, Hiroyuki. I think the lawyers are focused on this particular, role of law. And it is important to see what law as well as soft law says, and to be able to continue to persuade that should be an anchor for framing and for steering, various forces or various actions that market forces, tend to take. So I mean, I do see the value of what Hiroyuki is trying to champion in terms of going back to sustainable corporate growth and probably fleshing it out to give it more meaning. And in this day and age, I think the meaning of that can be quite fluid, and the fluidity is not necessarily a bad thing. Hiroyuki, do you have a response to any or all of your panelists in terms of what you have gained from what they have said, and how you might want to, change your paper or your arguments in any way?
Yeah, thank you. First, some points has been rightly pointed out regarding what has not changed so much in Japan. For example, directed labor market and the number of hostile takeover. And regarding the role of active shareholders, they greatly contributed to the active engagement between company and investors, and improve corporate financial efficiency. But so far, they leveraged stewardship framework, not advancing sustainable growth. And Japan's Stewardship Code was initially conceived with the primary objective of promoting engagement between investor and company, a purpose which I believe remains unchanged today. In terms of the stewardship approach, this corresponds to straightforward shareholder stewardship. However, Japan's Stewardship Code has also explicitly stated promoting sustainable corporate development as a major objective since its first edition. So, this represents an expansion of stewardship into another dimension in various respects. For example, positioning a company's promotion of business activities, including social initiatives, as part of promoting sustainable corporate development, would, I believe, extend its scope beyond the company itself. Furthermore, I consider that when investors engage with such activities, their stewardship activities have the potential to evolve into action, benefiting not only beneficiaries but also various other stakeholders. And the positioning of stewardship code, yes, certainly it would be overly simplistic to assume that merely introducing software with a complaint or explain structure would achieve its intended purpose. However, regarding hard law regulation of sustainability activities, I believe it is preferable to confine directors' duties essentially to the scope of Section 172 of UK Companies Act, with the remainder governed by the general regulatory framework outside the Companies Act. This is because from a company law perspective, it is desirable for directors to retain broad discretion over business activities. The potential for companies to develop business activities, including social activities, as mentioned in my presentation, also presuppose broad discretion for directors and officers over business activities. And finally, regarding the role of life insurance, I understand they play a highly advanced role, particularly in environment E and S social aspect of ESG, while particularly advanced initiatives appear to underway in Europe, as you showed today. I expect Japan will follow this trend. On the other hand, concerning governance, G, major Japanese life insurance companies are regarded as the most conservative among institutional investors in terms of their influence on disciplining management, while also acting as stable shareholders. So while this is considered unavoidable due to transaction relationship with invested company, we shall keep a close eye on potential future changes. Thank you. Thank you very much for the speakers for your so valuable comments. I really appreciate it.
Right, thank you. Thank you, Hiroyuki, and thank you to all the panelists for your wonderful comments. And I'm sure that he will take them away and build a very strong paper on this. But so many interesting issues have arisen, and I have plenty of questions of my own, which we cannot further explore. With Hiroyuki's bombshell on, the role of corporate law, and its relationship with regulation, and in particular, I think regulatory drivers are very important. We have a continuing conversation. So may I thank all of our panelists here for supporting this event tonight, and thank you, Hiroyuki, for giving us such a wonderful working paper to read and to reflect upon. And thank you too for the audience for staying with us till the end. Till next time, please keep a lookout for our future events. I wish you all a very good evening. Thank you.
Thank you.